You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means it is Education Wednesday once again. Time, once again, for Options Bootcamp, the premier options education program. My name, of course, Mark Longo from theoptionsinsider.com, as well as from the ever-educational Options Insider Radio Network. Welcoming you to this second part of our double-header extravaganza here on Options Bootcamp. Of course, if you like what you hear, do keep rating and reviewing on your platform of choice. It does help new folks continue to discover the show. And if you want to listen to these doubleheader episodes, we've been doing a few more of them lately. They're fun. If you want to listen to these instantaneously, you don't want to have to wait a week or two for the other episodes to drop, theoptionsinsider.com/pro. That'll get you not only live access to the chat where you can ask your live questions immediately, but also to the Pro podcast feed where you'll get early access to all of these episodes waiting for you up there, so you don't have to tune in live if you can't make it, but you can still get them early. And then, of course, you get the Pro Q&A sessions coming up later today. We got the once and future Dr. Vix joining us to answer all of your volatility questions, Mr. Russell Rhodes. So a lot of great content there, as well as options oddities at the end of the week. So a lot of fun over there, as well as giveaways are coming up on the March Pro Trading Crate giveaway. I have a feeling maybe we'll include in that Pro Trading Crate a book by one of our guests today, maybe a little bit of Options Playbook. Hint, hint, because we are joined by not one, but two people on this week's doubleheader extravaganza. First, let's go out to the dark and stormy land known as Frankfurt. Who would live there? Well, one guy I know would live there. He is the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to Options Bootcamp, sir.
Oh, it's always good to be back, Mark. Got some great stuff to talk about on the show, and I can't wait.
All right, and also joining us for part 2 of his doubleheader extravaganza. You know, he missed it. He was jealous of Dan on this show. He said, I want to be a part of the other show that's going up all the time on Education Wednesday. You know him, you love him as the options guy himself. He's slumming it from OPR today, joining us on Options Bootcamp, none other than Mr. Brian Overby. Brian, welcome to now your second episode of Options Bootcamp, sir. How you feeling? You having fun?
Yeah, I'm on a roll. I'm ready to keep it going.
All right, let's keep it going then with a little bit of the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, let's do it. It is time for you folks to deluge us with your questions. And man, you folks have not been reticent. Tons of fun questions out there to answer here on the show this week. Let's get started by paying off. So actually, no, before we do that, you folks have been waiting with bated breath As part of our doubleheader. You wanted it last week. You're getting it this week. It is none other than the patented, the original, market taker question of the week. Mr. P, what you got for us, sir?
I have got one, an interesting one. We talked about on the last episode, my new trader tool that we developed on wing spreads. And this is a good one. This was a few years back. Somebody was trading did we talk about this last time? I don't think so. Was trading a directional condor.
You did mention directional condors recently, yes.
Oh, I did. Oh, damn. Because that was a good one. Well, shoot, man. Now I need a new question.
Tell you what, I'll buy you some time as we go through our own questions of the week out here with the audience. First, let's go out to the one we were just talking about a few minutes ago. For you folks, it was a week ago. It was our current question of the week, which is, which type of fly trader are you, listeners? Are you a traditional fly trader? Are you more of a broken wing or skip strike fly trader? Or are you more of a situational trader? That has evolved a little bit since our last episode. It's still tied 42.9% each for traditional versus broken wing, but we have about a little over 14%, about 14.3% saying now you're also situational traders as well. That is our question of the week. That is currently running by the time this airs on the on-demand side. The podcast side, that will be complete. That's a good reason to follow us at Options on Twitter throughout the week, listeners. We have questions like this, content flying fast and furious all week long. So if you want to participate in our questions of the week, make your voice heard. Just changed again. Twitter now traditional is right around 50%, broken wing at about 37.5%, and the situational is 12.5%. So it's moving all over the place, listeners. At Options is the place to go. Our question of the week last week, we asked you folks, what's your favorite option strategy to leg into stock positions at lower prices? We gave you a couple of the choices in the infamous other. We gave you the old straight-up short put, kind of plain vanilla, but it works. It's good at its job. Or a little bit fancier, the old 1x2 put spread, long 1, short 2, kind of more of a moving target way to leg into the stock where you're not really maybe sure exactly how much movement you're going to get. Maybe you want a little bit more cushion, a little bit more wiggle room versus the straight short put. Well, then the 1x2 put spread has you covered, or other. And 47.4% of you went with the short put, kind of as expected. 39.5% saying the 1x2 put spread. So actually a closer race between the two than I thought. And then 13.2% of you chimed in as other. We had some interesting suggestions along those lines in terms of what you folks thought on the other side. You can find those over there at Options if you follow us there, listeners. We also asked you recently about contagion risk. Everyone is freaked out about contagion risk right now after the meltdowns of Silicon Valley and First Republic and everything else. So we put it to you recently. Is this a canary in the coal mine of worse problems ahead, or is it just a tempest in the teapot? And you know what? You folks, maybe understandably so, given what we're seeing in the market, couldn't really make up your mind. 51% saying it's a canary in the coal mine. There is worse yet to come. Or 49% saying it's a tempest. It's just going to blow over. So almost 50-50 exactly, which is unusual for our audience. Usually our audience has an opinion, and they're not shy about sharing it. Mr. Bryan, we'll start with you. Do any of these results surprise you? First off, looks like the traditional fly is now winning in our poll. So does that offend you as our resident skip strike guy? And then B, are you surprised that the short put took it over the ratio 1x2 put spread? Or the fact that our audience can't make up their mind if this whole banking thing is the beginning of worse to come or just a tempest in a teapot, sir?
All right. I love it all. I love the fact that the short put spread got to 40%. I think that is wonderful because on the put side of things, I love to think about a ratio put spread to get myself into the stock. It's just a very interesting. I'd rather do it on the put side than I would on the call side. It just makes a little bit more sense on a stock that I would like to buy, especially if I got the cash to do it and I'm doing it cash secured. So I do love the fact that came so close on that price to give a battle to the short put spread. And worst yet to come, I can understand that without a doubt. And it's as far as the banking situation, it's just so sad because the big banks get bigger. And there's been a couple of banks that have said that unless you have a relationship with us, we're not willing to take some deposits. There have been a few that have came out to try to help with the smaller banks. But it's a sad thing that has happened. But the Fed moving as quick as they did there's obviously going to be a little bit of kickback to it, and that's what we saw, a little bit of blowback over it. And worst yet to come. I hope not. I hope not. There are some banks out there that there are some opportunities. You look at what happened to Charles Schwab; they got beat up, and don't really understand why they're getting beat up. If anything, they might be a benefactor factor here in that they have large assets and they have a very solid presence, and they're trying to take over the brokerage industry, just in general when they went to zero commissions. So I don't know. I think there's opportunity. Worst yet to come. There might be a few others, but the government's has stepped up and said that they are going to make good on any deposits in those banks that are having problems. So the last one is that, you want me to comment on that one too?
It's up to you, sir. You are our guest.
All right. I guess I would be, I'm surprised that it's not a little bit more 50-50. As far as crypto is concerned, it is, it does provide liquidity in the marketplace. I see a reason for crypto to be there, as opposed to concepts that like Warren Buffett and other very respected people have mentioned that have talked about crypto. So I do think there's going to be some form of it around. I do think that there is a need for it. I don't necessarily think it's a flight to quality, but I would kind of expect the public to be a little bit more towards the 50-50 end of that. So I'm not surprised at those numbers, but I get it. I get where we're at with the crypto space.
Yes, you even hit on that one. I forgot to mention that one. We did a flash poll last week during our Crypto Rundown show, listeners. We asked you, given the fact that crypto was rallying when the market was selling off, is crypto the new flight to quality asset? We kind of did this as a bit of a tongue-in-cheek poll, but you folks really were evenly split. Yes, almost 47% and 53% saying no. So pretty close to 50-50 whether crypto is a new flight to quality asset. So some pretty surprising stuff there. All right, Mr. P, if you have any thoughts on those, have at it. And then B, more importantly, what is your much anticipated MTM question of the week, sir?
Oh, yes. Well, I've got thoughts on everything, Mark. Because I've been talking a lot about wing spreads, some people have asked, what's better, iron condors or iron butterflies? And that one, of course, it depends, right? I find that iron condors, let me start with iron butterflies. I find that iron butterflies, because they tend to have tighter range. I mean, you can expand the wings, but you end up getting sometimes a worse risk-reward scenario. So they tend to work better for small time periods, like 10 days or less. Whereas iron condors, you can trade them with a bit more time, and you can really extend those wings out pretty far and creates a not too bad risk reward scenario when you weigh it against the probability of success. So they kind of serve different purposes. They have some similarities but different purposes. So as far as our polls go, I mean, I am a fan of short puts when traded properly. And this is something where, like, I have in the past thrown a lot of shade on short puts because I think a lot of people don't trade them as they should. And I think maybe we're going to talk more about this later, so I don't want to dive too deep into it, but we can later if we need to. So yeah, I'm a fan of the short put relative to some of the other things we talked about.
Sounds like a plan, sir.
As far as the canary in a coal mine or 10% in a teapot, that remains to be seen. The 51% for worst yet to come and 49% is this will blow over is probably about how my brain weighs them. we'll see. I hope it blows over, but I think there is a good chance that the worst could be to come. We are make no mistake, we are in a banking crisis right now. It's just that so far it's been being handled. And is crypto, particularly Bitcoin, the new flight to quality? I'm just going to go out on a limb and say no, because gold has historically been sort of the international currency of last resort, and throughout most of history, including U.S. history until 1971, it was our currency. Dollars were just basically a piece of paper that could be turned into gold whenever you wanted until 1971. And so that's just how humans work for whatever reason. It's kind of stupid, but for whatever reason, that is the currency. And if major world war comes, zombie apocalypse comes, and like cities are being destroyed and such, your Bitcoin doesn't do anything for you.
Can't throw it at the zombie. We have discussed this: the weight of Bitcoin versus your gold or your hefty, trusty axe.
Yeah, I mean, your paper wallet gets burned up in those scenarios. Like Bitcoin becomes a really silly thing when the stuff really hits the fan, and that's really what gold is all about, is for when it hits the fan. So
that's why Dan lives in Frankfurt, listeners. He's a bit of a prepper out there. Yeah. He's building his compound as we speak.
Yep.
Well, Dan, there are some folks who agree with you out there. I don't know, they're crazy people, I guess, but they do like you, including after our last episode. It was our episode 229, talking about options events and perhaps the lack of good ones out there. A Metal Maven chimed in to just say, when Dan speaks, I'm gonna listen. So there you go, Dan. You got a fan in Metal Maven, sir.
All right. Well, hey, that sounds great. Thanks for listening.
I like his musical taste. There's no accounting for his options taste, but hey, to each his own at the end of the day out there. Let's keep rolling with see how many of you folks we can squeeze in. Let's go to CVAO2. They want to know, why are there so many options exchanges? Are there meaningful differences between them that I should know about to improve my options trading? Ooh, man, where to begin on this one? I just came back from a big industry conference. There are now, 17 plus, 18, 19, I lose track at this point, options exchanges out there. Most of them owned by the same handful of exchange groups at the end of the day. And really all they are, CVA, is just ways for the same exchange group to trade the same contracts at different price levels. Sometimes they will charge you a taker fee. Sometimes they will provide you with a rebate, all around the same contract. Apple, whatever it is, the SEC says they can't charge different rates and different prices for the same thing. So they have to spin up new medallions to do that. And it allows them to incentivize different types of order flow. One exchange is a maker-taker, one is a taker-maker, and so on and so forth. And they carve up the space in that way. That said, Mr. Brian, what are your thoughts from CVA? He wants to know, why are there so many of these freaking things, and should it really matter to him as an options trader at the end of the day?
Well, it definitely should matter. Now, if you go all the way back to when there were a lower number of exchanges available, there was a big push from the SEC to stop having singly listed option contracts that were being traded on just one exchange. For example, Apple would trade on one exchange, IBM would trade on the Chicago Board Option Exchange. I remember the IBM pit was really big when I was down on the floor. And when they brought in the other exchanges and said that you can no longer do this, you can no longer singly list these stocks, the markets became a lot tighter. So it does matter that we have a lot of competition in different places of around the U.S. And I don't know if we need as many as we have right now, but definitely having too many exchanges, in my mind, is better than having too little exchanges. And that was proven by the fact when the regulators came in and said, you can no longer single list on just an exchange, And that definitely tightened up the markets in the options trading world. Probably one of the best things that ever happened to the option trade.
Dan, what are your thoughts for, what was the name here? I just had it, CVA02. Is this something that should inform their options trading, sir?
Well, it's a really, really complicated issue, and I like to try and keep things as simple as possible. And it's hard to do that. I mean, like, there's basically three things you don't want to see made: hot dogs, laws, and option pricing. Right now, all the behind the scenes stuff is just crazy, man. The reason exchanges started is so that there was transparency, right? Like back to, original exchanges, we're talking in the Netherlands in the 1600s. They started so that some people could make a deal with one person and cut out another person and say, hey, how come you bought it from him? I would have sold it cheaper, like having everybody all in one place, whether physically or virtually, and full transparency is a good thing. That's why exchanges exist. And now it's fragmented, and we have lost a lot of that. I mean, Oprah holds that together somewhat, but it's messy. It's messy. So I don't know. Work within the system that exists right now. You can look at the different exchanges because you can kind of, I won't say game the system, but use the fact that there are multiple exchanges to your advantage if you're smart. Work within the system we have and get good at it.
Yeah, it's interesting. As Dan mentioned, it does fragment it. All these different venues, that liquidity is fragmented across many more venues than it was 5 or 10 years ago. So that does complicate things. Single leg trade, single options, you really shouldn't have too much of a challenge. The NBBO, you hit it, you lift it, you work somewhere in between. That's not really going to impact you. Where these multiple exchanges and the fragmentation of liquidity can come back to bite you are in multi-leg spreads, because exchanges still maintain spread books that are siloed to the individual exchanges. And if your spread order goes up at a spread book at Philly, for example, but it's bid better at the CBOE, it's not going to automatically always be routed there. Your broker has to do that. There's a lot of other obtuse things. So on the spread side, which is the way we want you folks to trade, it's how we want you to progress as options traders. When you progress into multi-leg spreads, that liquidity and that fragmentation can come back to bite you sometimes. And it's a question we get from a lot of more advanced options traders. Why am I not done on this spread? It lines up on the NBBO, but actually the NBBO is not what matters there. Is what matters on your particular spread book, and whether your broker will get you done by moving the order. There's all sorts of nuances there. So it can cause issues from a fragmentation perspective, a CVA02, especially as you get into more advanced spreads. Let's keep rolling. Let's go out to one of our pro members, Don't it P. He says, he's going to hate me for saying his name that way all the time. I just love to say it that way. As a quick follow-up for Mark, Matt, Dan, and anybody who wants to listen, is it a good time to buy and hold banks or step into some long-dated calls? Good quality banks are down huge. Even Schwab seems ridiculously beat up. Small regional banks, Bank of America, JP Morgan, what is the play? Thank you guys for all your help in interpreting these markets. Well, Brian, you were just talking about this and how Schwab is pretty beat up in your opinion. What do you have to say for our pro member here? Don't it be? He wants to know, what should he be looking at? What should he be up to in the banks right now?
Well, yeah, and I did mention, I feel much the same, that there are a lot of values out there, especially ones that are not at risk of default. If you're going to play in the regional banks, that's a scary spot to be. I don't think that scenario or that story is played out yet. But Schwab is one of them that we talked about. They don't have a lot at risk considering what's the news of the regional banks and deposits leaving their firm. If anything, they're probably going to get bigger. And that's one of the sad things about what's going on in the banking system, is that the big banks become bigger because of this. And it's happening right now. And it just becomes an ongoing battle when you have situations like this. So if you want to try to take advantage of the banks, I think you're still obviously going to have some volatility, and it's showing up in the option contracts. They're trading at, like Schwab, for example, is trading at about a 10% higher implied volatility than it was before all of this started. And because of that, you're going to have that volatility if you're looking to buy some longer dated options. So you're going to have to pay up for them. The concept that I would look at, or that I've mainly discussed, is the fig leaf, right? Looking at buying the longer term option and then selling some of that higher skewed vol premium against it, basically setting up a covered call. That would be the strategy that I would go to if I felt that I wanted to participate in some of these banks on a longer term basis. So I think that's enough said.
Mr. P, anything to add there, sir?
Yeah, I mean, I'm just going to go big picture. Eric talked a little bit about implied volatility and such, and I said this either earlier on this show or later on the last show. Make no mistake. I mean, we are literally in a banking crisis right now. It's just that it's being handled okay thus far. And hopefully it will continue to be, and it'll be a moot point. So how do you handle it? Very carefully. Going in and just buying up 1 million straddles on banking stocks may or may not be the best idea. I have been selecting some of the banking stocks to pick straddles on. But I think a better thing is to be cautious. With the market rallying up this high, before we were in a banking crisis, we were bouncing around these levels sometimes. And I'm not necessarily seeing any signs that the economy is getting better. In fact, if anything, if the Fed is succeeding in cooling off the economy, we're going to see it get worse first. And BlackRock just came out and said that they think that this talk about the Fed lowering interest rates in 2024 might be a little hasty. So with the VIX at 19-ish, I think we're probably looking for spots to be hedging. First of all, hedging long-term portfolio investing. And if you can find some cheap implied volatility, and some of the banks are priced fair too, they make some pretty good long volatility plays.
Well said, sir. All right, we're coming up against it. I want to try to squeeze one more person in here. So let's squeeze one more person in here as the music pops off. There we go. All right, let's go out to, we're just talking about positioning, looking at the market. This comes from Dalford. Dalford wants to know, how do the hosts think about bullish risk reversals in SPX or SPY right now? Is this a favorable time, and how would you go about setting it up? How far out of the money on both legs, and how far out in time? Thanks. He's got a multi-part question. Mr. P, you're just talking about your outlook in the markets. Maybe we'll start with you, sir. What do you have to say for our friend here, Dalford? He wants to know, are you a fan of bullish risk reversals right now in the S, given the fact maybe you think we're about to sell off a bit, maybe not, or maybe so. And then he wants to know, how would you set it up if so? And then when you're done with all that, sir, if folks want to check out what you got cooking in the land of MTM, where should they go? What should they do, sir?
Sure thing, Dalford. So, risk reversals is one of those things that, depending on which neck of the woods of this industry you're in, it can mean different things. What I think you mean is when I would buy an out-of-the-money call and then sell an out-of-the-money put, so two different strikes. So there's a gap in the middle where, it's effectively flat, right? So you get upside if the stock goes up high enough, and then you get downside risk if the stock goes down low enough, and in the middle you're flat. So they're, doing something like that, I don't know, I guess can be fine depending on what you're trying to accomplish. If you are bullish, I guess in a way you're financing what you're paying for the call by selling the put, but then again, you're going to have to post a great deal of margin, so you're really paying for it anyway. You're really still putting up a bunch of cash. I don't know. I mean, my gut instinct is maybe it's being a little fancier than you need to be, but if you have a specific reason for that and believe that it's better than a differently constructed play, then hey, I'm good with that. But, never get fancy just to get fancy, right? And what's going on in the land of MTM? Lots of stuff is going on. For those of you listening live, we have got a presentation coming up in, an hour and a half. That's all on Wingspread. Specifically, I'm sort of unveiling this new trader tool that we developed to help you find very high probability wing spreads traded by professionals that you're going to love. And you can sign up for that by going to markettaker.com/REG. And if you're listening to this next week when it comes out officially as a podcast on, as a recording, then check in with us. Just hit markettaker.com because we've always got something cooking, man. We've always got something cooking.
Always cooking with that second T for Theta, markettaker.com. Mr. Options Guy, we will leave the final word to you, sir. First off, what are your thoughts on bullish risk reversals in SPY or SPX right now? Do you like them? Do you hate them? And how would you go about them if so? And then B, if folks want to keep up with everything cooking in the land of Options Guy, where should they go? What should they do?
All right. Well, I think Dan covered the SPX and the SPY and the risk reversals fairly straightforward. If you want to get long those underlyings, I mean, there's obviously just getting long the underlying is one of the easier things to do in the marketplace at this point in time. So to look at a risk reversal, I don't talk about them. You're just getting a little fancier than you probably need to be. I personally just would rather want to go deep into money calls. If I am doing these type of trades and I want to get bullish in those underlyings, I prefer to go that route. And like I said, if I'm going further out in time, I'd like to consider selling some premium in the short term. We talked about it with the Charles Schwab situation. I think that would be the way that I would like to lean, as opposed to looking at it this way in the SPYs or the SPX. Just straightforward, and then everything else that Dan mentioned around it on how you're setting it up. Exactly. You can try to get a little bit better landing area where your risk and reward is. That would be the main reason why I would do a risk reversal, to have that little area depending on the strikes that I wanted to use. But in general, I think I'd rather just be buying deeper in the money calls and maybe selling some short-term calls against them. As far as the Options Guy is concerned, follow me on Twitter. My handle is very simple. It's @BrianOverby. I'll tweet about everything that's going on with the podcast here very shortly, and just keep up with all the things that we're doing with Options Playbook Radio and the Options Playbook.
There you go. Give him a follow over there @BrianOverby, OVERBY on the old Twitters. That's going to do it for this doubleheader extravaganza of Options Bootcamp. But for all you pro folks, you got more coming. You got a trifecta coming up, because in a few minutes I'll be joined by the once and future and now present Dr. Vix, Mr. Russell Rhodes, author of many options and volatility-oriented tomes, specifically to answer all of your questions. He got a great question from one of our pro members back at the beginning of the year about how to plan for a potential pop in VIX over the next 6 months, and he's been trading it out in real time, and he's got it on his blog, and he's made a whole bunch of content around it. He's going to be giving us an update on that this week as well. So a lot of fun. Check that out. If you're on the pro, just stay tuned. He'll be joining us in a little bit. If you're not on the pro yet, theoptionsinsider.com/pro is the place to go to get access to that and pretty much 200 other episodes of awesome exclusive options goodness, live streams, giveaways, the March Trading Crate. You want to get in there soon, because the March Pro Trading Crate is going out in a couple of days, listeners. So stay tuned for all that fun, and then stay tuned for next Education Wednesday, another episode of Options Bootcamp. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's MIXLR.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.